Chapter 3, Recording Transactions and the Multi-Column Journal. 3-1, Recording Transactions and the Multi-Column Journal. Accounting is keeping track of money. To keep track of the money, all of the transactions are recorded in journals. If you watch A Christmas Carol, Ebenezer Scrooge ran an accounting company that would have hundreds of journals keeping track of the transactions from multiple other companies. These records required a lot of people working to write things down and double check everything. Today, much of the work is done by computer, but still needs to be monitored by people to prevent fraud, which is theft, by people inside the business or companies and the businesses that they are doing with transactions with, whether that is buying or selling. A company will keep records of financial transactions on different types of paper called source documents. Checks. When a company spends money, it can be in the form of a check. A person from the company fills in the check and gives it to another business as payment. The receiving business can take the check to the bank, which will transfer money from the original company's account to the receiving business's account. If it isn't filled in properly, the bank can deny the money transfer. So always double check it is filled in properly when you receive a check. Sales invoice. When you sell an account, you will have an invoice to track the sale. If your company sells a lot of products or services to another business, instead of paying each time, you keep track of the invoices and bill that business once a month, for example. It means that the selling company may not get paid immediately. If a business or person does not pay regularly, they may lose the privilege of paying on account. Receipts. When you purchase a product or service, sometimes you will get a receipt. A small piece of paper that shows how much you paid that is printed out by the cash register machine. One copy is given to the customer in case they want to return a product, and a copy is kept by the store to keep track of the sale. At the end of the day, a cash register will print off a list of receipts for the day, which gets turned into the accountants for tracking purposes. Memorandums. These are similar to a sales invoice but are more like a contract detailing the service product and the terms of payment. These are used to track a sale that is negotiated between two parties. Calculator tapes. This is also the name for the list of receipts from a cash register at the end of the day. This is turned in to check that the cash in and out of the cash register is correct at the end of the day. Also, some calculators will print off a paper tape as sales are calculated for paper tracking purposes for accounting departments. The source documents are kept in case there are questions or an audit. An audit is basically an official double check. All of the information is compiled in a journal which summarizes the information for the accountants and the owner of the company. Let's take a look at the work together. Transaction 1. Received cash from owner as an investment, $2,800 shown by R1. This is the owner putting money, in this case $2,800, into the business, and it is recorded on receipt number 1. On page 62 in the textbook, we can see this as a general credit and cash debit. So under date, we put April 1st. The account title is Norma Dirks Capitals. Document number R1. It is a general credit $2,800 and a cash debit $2,800. Transaction number 2. Paid cash for supplies, $415 shown on C1. On page 62, we can see an example. The $415 is recorded as a general debit because we are paying money out and a cash credit because the supplies we have value. This is recorded on C1, which is a check number 1, which the owner wrote to pay for the supplies. So under date, we put April 2nd. The account title is supplies. Document number C1. General debit is $450 and the cash credit is $415. Finish this up and try the on your own question.